make big money with apartment investing. All right, so the first way, and if you are just a buy and hold investor, and a buy and hold investor is someone who is going to put down a down payment, and I'm talking apartment buildings specifically here. You're going to put down a down payment and buy something that either somebody already turned around or someone's actually kept it up and running. They've kept it up and running all along, so it's good. We don't have as many financing options when it comes to that because there's nothing to be done with the building. You're literally just buying it and you have it. And that's a great thing to do if you have a chunk of cash, you need to put it somewhere, and someone else already did it. You don't mind paying the full value of the apartment building. Maybe you don't have time, you just want to hire a property manager. So that is one way, just to hold it for cash flow. That's one way to make money with apartment investing. That is not my preferred way, because I know that there's ways you can make way more money, but this would be probably the least time-consuming one of them, and more friendly for people who have a chunk of cash to put down. As far as financing, you're pretty much going conventional. I'm going to share something with you guys. Somebody called me off my website a couple of days ago and just said, hey, I just have a question for you. Like, okay. And it was a great question. I'm going to record a little video and stick it on my website because I'm sure other people have the same misconception. When it comes to apartment investing, I've heard a lot of people, and I heard the same thing when I was new, say, well, when it comes to apartments, the financing is not based on you. It's based on the asset, or based on the building, right? Have you guys heard that before?
Yeah.
Yeah, okay, so did I. And what I want to share with you is, to a certain extent, that's true, but not to the full extent. If you think that a commercial bank is going to look, a standard commercial bank is going to look only at the asset, and they're not going to look at the borrower who's behind the asset, you are mistaken. And the reason I share this with you is not to scare you, oh gosh, well if I don't have good credit, that means I can't do this. It doesn't mean that at all. I mean, I'm still recovering from bad credit. It doesn't mean I don't invest. What that means is, if I'm interested in that, I don't do this kind of investing, but if I'm interested in this kind of investing, this is what I'm going to do, and this is what you would need to do. You call some commercial banks, and you give them some kind of scenario, and find out what they're looking for. What are they going to look at when it comes to credit? Okay, and if you aren't that match, then you know what your future partner needs to look like. And you go and you seek out that type of person to partner up with you until you're at a point where your credit has been fixed. When I worked for Leo, we were refinancing a 126-unit building. They looked just as hard and just as deep into Leo Fry, who had more money than God, which we could show them with a bank statement. I mean, it was liquid cash because we were going to build this big building, so he's holding it liquid. And they still did all sorts of background checks on him, credit checks, called a multitude of different banks that he had relationships with to make sure that there was integrity and creditworthiness with the borrower. And that shocked me because up until that point, I didn't realize they looked that deeply in. And they do. Okay, so if you know you want to get into this area of investing, don't start moving forward with your deal thinking, oh, they're just going to look at the asset. That's not how it works, and especially now, especially after the credit markets crashed and everything is so much more tight than it was. That's something you need to know. What are they looking at? If you're not that yet, go find it, okay? There's really never any reason that you shouldn't be moving forward with your real estate investing. It's always a matter of finding what you're missing so that you can move forward. Okay, so the other way to make money with apartments is by doing flipping and cashing out. Okay, so by cashing out, I mean we buy it, we do the management turnaround, we get it all fixed up. And this is not something like where you might flip a house and it takes 30 to 90 days, and depending on the market, maybe 6 months. It depends on how long it's going to take to sell. When it comes to apartment buildings, I don't ever delude myself into thinking that this is going to be any less than 6 months. And more realistic, I'm like 9 to 12. Unless it's a really big project, like the project that we're working on now. It's not closed yet. The project we're working on now is 355 units and is 39% occupied. That is not a 12-month project. That's like a 24-month project. That is a long one. But when it comes to flipping apartments, it's going to take a longer time. So when you're looking at pros and cons, okay, well, is that a pro, is that a con? It depends on what you want to do. If you're looking for quick cash today, flipping apartments doesn't give you quick cash today, like wholesaling or flipping a house. But one of the benefits of it is the profit margins can be much greater. Like I never look at doing a flip on an apartment building unless the net profit is a minimum of 6 figures. and multiple six figures is more what I'm interested in. So if it's not paying me at least $100K, I am not interested, because I'm going to spend 9 months to a year. So I want it to make sense that I'm going to do that. I typically only do 1, rarely 2, at a time. So it's got to be enough profit to make sense for me to put in that amount of time. Does that make sense?
Yes.
You get a CD for saying yes. Okay, you're ready. You get one anyway. All right. Some of the other cons. Actually, anyone have any idea? So if you're going to flip a apartment building and you're going to sell it outright, anyone else have an idea of what a con might be to doing that? I don't want to call it a con, but it's something we need to be aware of. Let's say you sell it in 11 months.
Hard to find buyers.
Hard to find buyers? Actually, I'm glad you brought that up. That's actually not it, but I'm going to address that real quick. So here's the thing. If we're doing this kind of real estate, who are our buyers? Who are our buyers?
Usually, maybe someone's RA or account or something.
Okay.
Equity partners.
Maybe someone's IRA account, equity partners. In general, the buyers for this are going to be the same one that was the first investor. Typically, a professional, maybe doctor, lawyer, dentist, somebody that has a profession, that has provable income, even though it's not based on their income, they have provable income, good credit, they have a chunk of cash, and they don't have time. They just don't have time to deal with this. They want something that's already done. That is my customer when I'm flipping apartment buildings. So personally, I don't find that it's hard to find those buyers. I just needed to identify who those buyers are so I can go after them. And it might be somebody in this room. It could be the same thing, but most likely it's going to be someone who's a professional that just doesn't have time. What am I looking at on time?
Only about 20, about 30 minutes.
Okay, good deal. Okay, but the con that I was talking about, so what happens if you hold a property for like 3 or 4 years versus you hold a property for 10 months and you sell it? Okay, a capital gain. So when you flip an apartment building, just like when you flip a house, particularly if it's under 1 year, so if I'm getting close to a year, I will on purpose delay the closing to go past 1 year, because the difference in taxes is 15% if it's long-term capital gains. I know this is boring tax talk. I'm not even a tax CPA, but there's a couple things I've picked up through real estate. If you hold something longer than a year, you only pay 15% federal tax. If you hold it for less than a year and you sell it, you pay whatever your tax rate is. So if you're in the 25% tax bracket or 34% tax bracket, I don't even know if those are right tax brackets, but you get the picture. You're going to pay it at your rate. Okay, so a big chunk of whatever you made on that is going to go away. So when you are deciding what you want to do in your real estate, you need to take that into account, because that is part of your profit. That's now going to be an expense when you just sell it outright. And that might be completely fine, but you'd rather know going in than realize after the fact, oh shoot, I thought I made 100 grand on that, and really I only made 70 grand. Okay, especially if you're planning on the higher amount.